Hello, everyone, and thank you so much for joining us today for the part one of BFSG's four-part 2022 summer webinar series with a special guest today. With that, let me give it over to our panelists for introductions. Mr. Paul Horn.
Hi, everyone. My name again is Paul Horn. I'm the Senior Financial Planner here with BFSG. So I help oversee the financial planning activities for the firm. Happy to be here. And then John, introduce yourself as well, please.
Thanks, Paul. Yes, I'm John Clark. I own Pathfinder Senior Care Consulting. Our specialty is helping families figure out strategies to pay for senior care.
Thanks, John. Mr. Paul, you want to kick off our presentation today? What are we going to talk about?
Yeah. All right. So today's primary topics we'll be covering is, number one, what are the different types of care that are being offered? What exactly is a long-term care plan? What are the different ways to cover the costs? What are the pros and cons of each of the different strategies to pay for a long-term care plan? And then finally, how does Medicaid work? And what exactly does it cover? Those will be the primary questions we'll be looking to answer on today's presentation. So why do we need a long-term care plan? The first reason is just going to be longevity. People are constantly living longer and longer, and this is great. It just means that with a longer lifespan, there's just going to be more expenses associated with that. In fact, I saw a study done by the Society of Actuaries not too long ago, and it predicted that if a married couple reaches the age 65, there's a 2/3 chance that at least one of them will reach age 90. We can just see here, back in 1990, the average age was about 84 for women, 80 for men. 2020, it's gone up a little bit for women, gone up about the same for men. But by 2090, it's projected to be about 89.3 for women and 87 for men. So as the years go on and technology gets better, people are just going to continue to live longer. So something we definitely need to be aware of.
Yes, Paul, you want to do that first poll? I know we're going to have pretty much two polls back to back for the group. So before Paul gets in this one, this is going to have a poll on it too, but we kind of want to gauge the audience real quick with a quick have you ever poll. So again, for all of you that have been on prior BFSG's webinars, this will pop up on your screen if you're on the computer in just a moment. Let me launch polling. And the question is, have you ever had to assist a loved one that needed long-term care, like a parent, sibling, or spouse? You got basically yes, I have, or no, not yet, assuming that most people at some point will need to do that for some type of loved one. I'll leave that up for, again, about maybe 15 more seconds as we gather responses, and I will share results with the group. And with most responses in, let me close polling real quick and I will share results. And as you can see, it's pretty good, actually. We have about 40%, 44% say, yes, I have had to provide this type of care. And about 56% say, no, not yet. So I think this will actually be a really good presentation for the group, kind of talking about some of the things you can expect as we go through this. Thanks, Paul. I know we have another one coming up shortly too.
All right, so these are the different types of care that are being offered. One is skilled nursing, another is assisted living. There's what's called board-in care, in-home care, and adult daycare. John, can you just talk to us a little bit more about what each of these are and how they work?
Certainly. So these days, we oftentimes hear people say, well, I need to go to a nursing home where my spouse or my loved one needs a nursing home. Is sort of a catch-all term, but the reality is there are a variety of different levels or types of care. A skilled nursing facility is really the highest level of care, and you'll see two types of patients in a skilled nursing facility. You'll see those that are there for physical therapy or rehab, and then you'll see those patients that are there on a long-term basis. They're basically a bed care patient. So doctors, nurses, high level of expertise that's there, very hospital, institutional-like feeling place. The next level down is an assisted living. I like to compare this to between a cross of a hotel and an apartment building, where if you went in the front door, you'd see a front desk concierge, you'd see restaurant-style dining, you'd see lots of common areas, The residents there have their own little apartment. They may be up an elevator and down a hall. So they have lots of privacy, but they have caregivers that can come on an as needed or on a pre-scheduled basis. They have lots of activities they can participate in, lots of socialization opportunities. And the price range and luxury level of this ranges broadly. Recently, the more common types of facilities that are being built are the more upscale, really beautiful arrangements. They really look like more like resort style living. Board and cares are for really a higher level of care, I think, than an assisted living. These are houses that have been converted to care facilities. Some states have a really broad, rich industry of this. These houses will have up to 6 patients in them, and they'll have 2 caregivers. So it's a really good 1 caregiver to every 3 patient ratio. A skilled nursing and assisted living would be more like 1 to 10 or 1 to 13. Whereas in a board and care, this is really for patients that need a lot of attention. They need to be within earshot of a caregiver, but they don't want to be in a hospital-like setting. So in a board and care, they can get like a 1 to 3 ratio. In-home care, of course, is just like it sounds. It's, of course, a 1-to-1 care ratio. It's actually the most expensive of all of those care options that you see up there. A lot of people are surprised to hear that, but staying in your home is actually the most expensive. Many folks think that this is what I would want to do, and I assume everybody else wants to do this, but the truth is actually quite different. You'd be surprised how many people would really prefer to be in an assisted living. And it's probably split 50-50, but not everyone has the same outlook about that. Adult daycare is kind of like a child daycare, in whereby you could take your loved one, or they actually would be picked up by transportation that's provided, take your loved one to a care community that's just set up for the day. They provide meals and activities, and in some of them they'll have nurses there, and then they bring the patient back home. Works great for someone that's working and maybe they're caring for their mother or their parent, and they really need someone to watch over them while they're away at the office. Which everyone prefers can vary, as I mentioned, and the price and cost level can vary greatly as well.
Yeah, and something I want to mention here, John, too, is it's not uncommon for people to kind of move to different types of care along the way. I had a recent family member suffering with dementia. She started in home care, and as the dementia got worse, moved to assisted living, and then finally moved to skilled nursing as her needs for care grew over time. Chad, do you want to take off with the next poll?
Let's do it. All right, guys. So, there's 5 different types of care that Paul and John just spoke about. And so the next poll is, when you think about any one of those, right? Not one in particular, but any one of those cares. Let me launch this. The question is, what percentage of individuals do you think will need any one of these types of cares at some point in their life? We got 30%, 50%, 70%, or 90% of individuals will need one of these types of cares at some point during their life. Again, I'll leave it up for maybe 10 to 15 more seconds as we gather responses, and then we'll close results, and I'll let Paul share the actual percentages. And with most responses seem to be in, let me close polling. I will share results. We have about 9%, very few saying only 30% of people, 15% say about 50% of people, 34% of our attendees say 70% are going to need this type of care, and 41% saying probably 90% of people are going to need one of these types of care at some point in their life. So, Paul, what's the actual statistic out there?
We have some good guessers here. The actual statistic is 70% of people 65 or older will be in need of some form of care at some point in their life. So with long-term care plans, we need to address this because 7 out of 10 people are expected to need some level of care, and this can be a little bit expensive. So, and it doesn't really matter how much money you have. At the end of the day, we typically want to find the most financially efficient way to cover this long-term care costs. So when you're doing planning, it's important to plan not just for yourself, but for your parents or for your kids as well. Because I know one of the biggest things that I hear when I'm talking with individuals is they don't want to be a burden to their kids. So I know that's one of the big planning conversations I have when I'm doing financial planning related planning with clients on this. So should you buy long-term care insurance? John, what are your thoughts on this?
Well, it's a common question that we get. And frankly, the answer is not an easy one because long-term care insurance is really just one of multiple ways of approaching this problem. I like to answer it by saying that, well, look, at least you should have a financial care plan. Traditional long-term care insurance is one way to do it, but what a lot of people end up deciding is that it's just too expensive, and they don't like the fact that if you don't use it, you lose it. You know, it's like fire insurance. All that premium goes, and I never had the fire, and I spent all that much money, and that oftentimes can bother people. So we put together here a presentation that addresses a variety of other methods. And one is a common one is, well, what if I just self-insured? Could I do that? You know, how much would it cost me? And what are the implications and advantages and disadvantages of it? And this idea is that we're basically designating a part of our portfolio. We're saying that we're mentally going to think of X% of our portfolio as being solely for the use of long-term care should I need it in the future. I'm not going to ever touch that part of my portfolio for anything else. Another method that's become more popular in the recent years is life insurance with long-term care features. This has some, I think, some really good positives to it in that we no longer have this problem of if I don't use it, I lose it. Let's see the next slide.
Yeah, and I know when I'm doing a lot of financial plans with clients, this is one of the things we always look at is some sort of long-term care needed. And like any other insurance product, it comes down to two basic questions I ask my clients. The first one is, if something happens, can you afford to pay the bill? So if there's a need for long-term care, can you afford to self-insure? If the answer is no, then we need to look at some form of coverage to help with that. If the answer is yes, you can self-insure, then I like to ask one more question. If this does happen where you need long-term care, do you want to pay the bill or do you want someone else to pay the bill? If you want someone else to pay the bill, then that could be another reason to look at some form of life insurance or long-term care insurance.
So, you know, when we tried to pull together this presentation that's basically comparing, you know, the different ways of approaching long-term care, namely long-term care insurance versus self-insuring, et cetera, we really had to think of a way of making it an apples to apples comparison. And that began with a real fundamental ideology. And that is that, well, how much insurance do I really need anyways? And the answer was at least a bare bones plan. Let's at least have some minimal amount of coverage. Well, how do we figure out how much that might be? We decided on using what is considered the statistically most likely scenario. In other words, statistically most likely length of time that the care would last and statistically most likely time when the care would begin and the statistically most likely scenario of what type of care arrangement I would use. If we at least had that, right? If we at least had just this bare bones covered, that's really fits sort of the 80-20 rule of having, I think, a fairly good plan in place. And in our presentation, the bare bones plan assumed that the care started at age 75, which statistically is the most likely age. And it also assumed that for women, the care lasted for 4 years, and that for men, it lasted for 3 years, which again fits the statistics. Keep in mind, though, that anyone has at least a 20% chance of needing more than 5 years. But if we're going after the most likely scenario, let's use 4 for women and 3 for men. We planned on that the care would end up costing about $6,000 a month. Why did we pick that? Well, it fits nicely under a scenario of about 6 hours a day of in-home care or full-time care and a board-in care. So if we had a plan that at least covered those two, you know, some part-time care in home, and if we needed full-time, then we would use a board-in care, then we got a bare bones plan. So we ended up at $6,000 a month of coverage. But what's I think has become more commonly, decided is that people are realizing I don't need insurance that's going to cover every dollar of the care because I do have some income. Now, I could probably afford to carve off some part of my Social Security to be applied against those costs. And in this comparison that you're going to see, we assumed $2,000 of that $6,000 a month cost would come from our own income. Therefore, the insurance that we need, or the plan that we need, must cover only $4,000 a month of the overall costs. We also assumed inflation, and this assumption of 3% was baked into here before the last few months. And I still think it's fair to do that. Those optimists of us do not feel that we're going to have 9% inflation forever. That's probably a temporary thing. I'm sure there's lots of debate that could be had about that, but I feel confident and comfortable about keeping a 3% inflation in here. So I think we covered this well. This, again, we're assuming the care begins at 75, women 4 years, length of coverage time, men 3 years. And you might ask, why is that? Women do live longer. We saw that in some earlier slides. And as a result, they end up needing care for a longer period of time. Once men start to have assistance requirements with bathing and dressing and walking and all of that, they tend to go downhill, or the life expectancy just tends to be a bit shorter than it is for women. You can go to the next one. Well, back to that original question about long-term care insurance, this I get asked all the time. How much does it cost? Frankly, you couldn't answer that in a casual setting, because it's different for every age. And it also varies depending on whether you're male or female. But we did try to pull together in one page a simple way to try to answer that question. That first column, you'll see that we've got for each age, starting at 40 to age 70. And then in the columns to the right, we're putting what's the annual premium for long-term care insurance to cover that most likely scenario that we covered, or that we talked about. And you'll see, for example, for a male who's 65 years of age and starting his long-term care insurance now, that his typical premium would be about $2,600 a year. For a woman, it would be $4,300 a year. Lots more, isn't it? And again, that comes down to the fact that they live longer, so there's going to be a higher likelihood they're going to need care to begin with, and the fact that their care lasts longer. Now, those prices there are for single individuals. If it was a married couple, you would take and combine those two costs and reduce it by 30%. So that little slide should give you a general idea, depending on what your age is, of what traditional long-term care insurance would cost. All right, so let's dive into the numbers. This is that slide that I mentioned where we attempted to try to do an apples to apples comparison of the different ways of preparing for the cost of long-term care. On this bottom axis, you'll see different ages. That's for age 40, 45, 50, 55, etc. So you'd find your age along that lower axis. On the upward axis is the overall cost in terms of how much would I need to set aside today in one lump sum to fund my care costs in the future. And so let's start with the bottom line here. That gold line is for long-term care insurance. And let's go to where it's got the dotted circle. So for someone who's 65 years of age, it's saying that they would need to set aside $18,500 in a pot that's, I assumed here, a typical average stock market growth rate. And that pot of money is going to fund the premiums to pay for that long-term care insurance. I wouldn't need to think about it again. I've just taken that $18,500, set it aside, and it's going to fund the premiums to pay for that long-term care insurance. That's how much I would need to set aside to do that if I was going to use traditional long-term care insurance. The blue line, or this light blue line, is if I was going to self-insure. And it's as if I'm going to use a stock portfolio. I would need to set aside $107,000 today as a 65-year-old in order to fund my long-term care costs that are going to begin at age 75 under that bare bones plan. That's the number right there. I would be carving out, you'd be asking yourself right now, based on the size of your own portfolio, hey, would I be comfortable in designating 107,000 of my portfolio as money I can't use for trips and vacation or cabins or anything? This is just to fund my long-term care. Many of you might say, yes, I think I can. I think I can afford to carve that much out of my portfolio. This next line up, this darker blue line, is if you're risk averse and you don't have a lot in the stock market, you're not comfortable with the stock market. In fact, right now you're feeling pretty good about yourself, the way the market has taken a downturn. Hopefully, it's certainly temporary, but this is not uncommon. There are a lot of people like you who do not feel comfortable with risk and prefer things like fixed index annuities or CDs. This is assuming that you used a fixed index annuity. How much would you need to set aside in order to fund your long-term care needs starting at age 75? So you're 65 years old in this scenario right here. You would need to set aside $131,000 in a fixed index annuity in order to pay for your care under that bare bones plan. There's a lot that's baked into each of those lines, but I think for now, let's just stay focused on those basic conclusions that each of those lines present. All right, so stepping back, what are some of the pros and cons of each of those scenarios or each of those methods that we've talked about so far? Certainly the long-term care insurance on the face of it is a very low cash outlay. It was just $18,500 that we needed to set aside. That's a big positive to that particular method. Whereas on the fixed annuity and on the stock portfolio, we're having to carve out a fairly sizable cash outlay. Under this criteria of don't use it, you don't lose it, well, that's probably the big weak spot for the long-term care insurance. If we never use it, then we've lost those premiums. That's certainly not the case with using the fixed index annuity or the stock portfolio. If we never needed to pay for long-term care, that money's still there and it grew over all that time. Either we ended up using it for something else or our heirs got to enjoy it, our spouse got to enjoy it. So it's money that's certainly not wasted. Long-term care insurance on this next row down where it says ready for care today, that is a big positive to it in that we don't have to wait for a bucket of money to grow. That if heaven forbid at age 66, we had some kind of accident and we needed long-term care right away, that policy is prepared to fund us for that statistically most likely length of time, ready to go. Whereas the other options do require time to grow. Another drawback to long-term care insurance is that it may be that we have some pre-existing health issues. Long-term care providers are pretty strict about what health conditions we have currently, and they may not allow us to even use that method, and we would really have to resort to the other two methods. Long-term care insurance, again, this criteria of is it principal protected? I think with that, we don't use that policy. We certainly have lost the premiums. We talked about that. So there's no principal protection there. The only one of those three methods where there's any kind of principal protection is that fixed index annuity. That's a main feature of annuities, is that we have some principal protection. Offset taxable income with medical expenses. Certainly with the long-term care insurance premium, it's tax deductible. Some other point, we have another discussion about this. I find that most people never really even get to use that deduction. Typically their standard deduction's higher anyways. And the fact that we have to wait until we get above 7.5% of medical expenses before we can deduct any medical expenses, blah, 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 means that most people don't really even benefit from the tax deduction of those long-term care premiums. The fixed annuity, this is one area where it really shines. We can control when we recognize the gains or growth on that fixed annuity. We can do that by drawing from the fixed annuity starting in the year that we're actually paying for our care. Now we can line up those gains with those medical costs. So as a result, we ended up with a lot of growth and paid no taxes on it. We can do that too, to some extent with the stock portfolio. Over time though, the manager is rebalancing that portfolio and there may be certain investments within it that fall out of favor that's going to cause some capital gains recognitions throughout time. It's true that many of the holdings may be within there throughout the whole entire holding period, but it doesn't quite as ideally line up with medical expenses as the fixed annuity would. Potential for greater return. That's where the stock portfolio certainly performs well. The fixed index annuities, they don't have as much growth potential as a stock portfolio would. But that's the trade-off, right? If we have less risk to no risk, then we're not going to have quite the growth potential. So this I think is an important slide to come back to when you're thinking about which method you want to use. They each have some different criteria or pros and cons. Let's move to the next one.
Yeah, one thing I just want to add real quick here on this stock portfolio where we're self-insuring. If you have a health savings account, that certainly would fall under this line here because those health savings accounts can be used to help cover those expenses. And those are growing triple tax free.
We mentioned earlier, there's another method that's becoming increasingly popular, and this is using what we call asset-based life insurance. So it's life insurance that has an extra feature of long-term care. It's essentially allowing us to tap into the death benefit before we die. It allows us to tap into that death benefit to pay for long-term care needs. This might be a good place to bring up what constitutes a long-term care need. There are 6 activities of daily living. If we need help with at least 2 of those, then we can trigger a long-term care policy or an asset-based life insurance policy. Those activities of daily living are bathing, dressing, spoon feeding, toileting, walking, and transferring. Transferring is going from a chair to a walker or getting from a bed to a wheelchair. So bathing, dressing, spoon feeding, toileting, walking, and transferring. We have to have need for at least 2 of those. You didn't hear in there, help with preparation of my meals or driving me to the doctor or medication reminders. None of that was in there. It's really those activities of daily living I just listed. The only other category that can trigger the policy is dementia. It's pretty rare, though, that I'll have a dementia patient that doesn't need help with some of those other activities of daily living. But the dementia alone, at least moderate level of dementia, will trigger a policy. So with the asset-based life insurance, if we needed help with 2 of those 6 activities of daily living, we could start to pay for our care using that death benefit. One of the things I like about this is that it's a lower cash outlay you'll see versus the self-insurance methods. Also, unlike the long-term care insurance, they can't raise your premium. Long-term care insurance companies do reserve the right to raise the premium over time. If they can justify before the state, because they do have to get it approved by the state and where you live, if they can say, look, the costs of care have risen dramatically, we need to raise the premium on all of our policyholders, they can do that. A lot of clients call us with a lot of shock and say, wow, look what happened, they raised it so much. That is a weakness of a long-term care policy. Whereas with the asset-based life insurance, they actually cannot do that. The premiums are guaranteed. It is ready for care today, like the long-term care insurance. If we had something happen at age 66, the policy is ready to go. We didn't need to wait for it to grow to a certain level. It too has the benefit of if you don't use it, you don't lose it. The premium, or rather, the death benefit will go to your heirs if you never used it. So in essence, you haven't lost it, right? Your heirs were able to benefit from it. This too kind of fits in the same lines of that. If you change your mind, 80% of your premium you can claim back after the premium term. So it does have a cash value to it that you could take advantage of. So again, I think it scores very well in that if you don't use it, you don't lose it category. It too has tax advantages as we use that death benefit early to pay for our long-term care needs. We can avoid taxes on that. We can match that up with our care costs. By the way, other existing life insurance policies can be converted to this type of policy. You can't exchange it for this type of policy. So it's kind of an interesting approach, I think. This gives you an example of what the costs are for asset-based life insurance. Let's go back to that age of 65. You'll see down towards the bottom. It has now an annual premium, it says, of $7,631. And that lasts for a limited period of time. We don't pay that till end of life. That's actually a 10-year payment. So at age 75, we no longer have to make those premium payments. And this is where I think people are commonly surprised or pleased to see just how much the death benefit is. In this example that I'm using, which was designed to cover that bare bones scenario, the death benefit is $96,000. And so even in year one, right, we paid $7,631 in premium. We have a death benefit that starts from day one at $96,000. So we certainly don't lose it if we don't use it. I think this slide's important to look at kind of in context of the others, in that when people look at this in isolation, they see that premium of 7,631 and they say, wow, that just seems like so much. But when you put it in context of the likelihood you're going to need care, what it costs to actually self-insure, what long-term care insurance actually costs, et cetera, I think it starts to hold its own a little better in terms of the viability of this particular strategy. You know, we just kind of gave you a taste of each of those different options there to get your mind thinking about, hey, there's more ways to approach than just one. But one thing that is something that's going to be universal for all of you is that you're going to want to do it now while time is on your side. Take advantage of the tax strategies that are there if we start this earlier, including the benefits of being in good health and the time value of money. All of those line charts were based on some time value assumptions that the money was growing over time. So it's better to start it off sooner rather than later, and including long-term care insurance. It actually costs less if we started at a younger age versus at a later age. And one other little plug we want to put here is if you're really serious about planning for long-term care, is work on getting your trust in order. If you don't have a trust set up yet, do. And quiz the attorney that you work with to make sure that they have an understanding of senior care, including Medi-Cal or Medicaid. And I think that's the next section of our presentation here, is we're going to talk a little bit about how Medicaid works.
Yeah, and I'm gonna let Chad take over real quick for a poll.
Yep. Thanks, Paul. So this is our last poll of the day as we get down to the last few slides before we get to what is a pretty good list of questions from the group that we'll get to at the very end of today's prepared remarks. So we just talked about, do you have a trust set up or do you have a plan? So we just want to gauge the group real quick. Let me launch polling right now. Is how many of you already have a trust in some form of long-term care, plan already in place? Let me leave it up for about 10 more seconds as we gather responses, and then we will resume with the last few slides before we get to all of your really good questions in the Q&A box. With most responses in, let me close polling. I will share results with the group. So we got, I think, 28% say I do already. 3% really good say, I haven't even thought about it. So at least most people here have at least thought about it, whether they have a plan in place already. So hopefully today's discussion and the next few slides will give a little bit more information for all of you that do not, so you can hopefully get the right plan in place. Paul.
All right.
So, as we talked about, the trust can make it possible to qualify for long-term Medi-Cal. That's one of the big reasons, besides just doing it to avoid probate and to make sure that your wishes are known and you have designated someone in your family to be able to manage things when you've lost cognitive ability. It's also really useful because it makes it possible to qualify for Medi-Cal. And I apologize, I'm not sure how many of our attendees are in the state of California, but I assume they're actually from all over, right, Paul? It's what percentage would you say is California? Yeah. So I am going to be talking mostly about California, but I will try to expand that to other states and the applicability of some of these concepts here. But Medicaid can pay for skilled nursing care. Medicaid is designed to kick in when someone has finished their physical therapy or rehab and no longer can pay, or rather could no longer make any progress in their physical therapy. And it turns out that they still need a high level of care despite all that physical therapy that happened. And most people that are in a skilled nursing facility are not really walking at all. They're pretty much wheelchair bound or bed bound. They may have some serious care in terms of pressure wounds, or they may have some ongoing infections that they're dealing with. Medi-Cal or Medicaid is there to actually pay for that after all of that rehab is done. And Medicare is what was paying for the rehab. You may notice that in your Medicare policies, it says that for those of you that are 65 or older, you'll notice that it says in there that it'll pay up to 100 days. But the reality is most people plateau in their progress well before the 100 days. And it's rare that you'll see many patients that got all 100 days covered in their skilled nursing facility. So Medicaid as a backup plan to be prepared for that is really important.
Yeah, and a quick story I want to tell here. I had a client that had Alzheimer's for 15 years. Spent down all her money. The only asset she had left was her primary home that she'd lived in. She'd bought it for $100,000 in San Diego. House was worth about $1 million at that time. So the family was thinking about selling the home, paying all those capital gains taxes, and then what was left over, using that for the mom. Instead, what they were able to do with proper trust planning here is go on to Medi-Cal, which does allow you to keep certain assets like your primary home. So the home was protected and able to be passed on to the heirs, and Medi-Cal was actually able to pay for her needs and services.
What types of Medicaid programs are there? Well, in addition to paying for a skilled nursing facility, like I mentioned, they also can cover the costs of nursing care inside of the home for patients that have ALS or Lou Gehrig's disease, for example. Anyone that's on a trach or a ventilator, it's possible to tap into an important Medicaid program that actually can pay for nursing care in the home. Not commonly known, but a very good resource. Assisted living waiver. Many states have expanded their Medicaid program to cover assisted living and boarding cares. So it's not always limited just to a skilled nursing. I've seen this waiver really prioritizing people that are currently in a skilled nursing facility. It's saying to them, look, if you want, we can move you to a boarding care or assisted living, much more home comfortable like setting, less institutional, and will continue to assist with the costs of it. That's the assisted living waiver. In-home supportive services is another program of in-home care, not as extensive as that nursing care I mentioned earlier for Lou Gehrig or ALS patients, but there is a program called in-home supportive services that can assist a certain number of hours a day for in-home care. Adult daycare, we talked about that earlier, that care setting where you can take your loved one while you go to work. Medicaid can actually help in paying for that as well. You know, I think a lot of this discussion that we're having here isn't just about planning for care for yourself, but it's also just equally about planning for care for your parent. So you might say to me, yeah, my assets and resources definitely don't fit any of the Medicaid programs, but this part of the presentation may still be very applicable to you because perhaps your parent does fit that, or we can get them to fit that. In the state of California, I say we can get them to fit that because in the state of California, we've got a lot of flexibility. California is very progressive, as most of you know. And in fact, recently, they changed their asset limits. Right now, for a single person starting this month, this just happened this month, they dramatically increased the amount of assets that a person is allowed to have. They raised it from $2,000 to $130,000. And there's a lot that's not counted there. IRAs and 401ks are actually not counted in that. Your house is actually not counted in that. Certain types of annuities are actually not counted in that. For a married couple, it used to just be about $3,000 was the limit. They've raised it to $195,000, and a married couple can actually tap into Medi-Cal. And here's the real big surprise is that in 2024, the asset limits in California are going away entirely. Lots of raised eyebrows, I'm sure, right now when you hear that and say, what? How can that be? Well, there's lots of politics behind that, but that's what's happening. There's no more asset limit. However, it's still important to do some planning with the assets. If we're intending to have Medi-Cal as sort of a safety net backup plan in case we needed a high level of care, that even though the asset limits are going away, the reality is the income that's generated from those investments will affect your income eligibility limits. So Medi-Cal does look at, although they're not going to count assets anymore, they will be looking at your income. And the income that's coming off of those investments will, of course, be added to your Social Security or your pension or what have you, and that could disqualify you. So doing some planning on with the what to be done could be done with the assets is important. And in California, we are allowed to do quite a bit of planning. There are certain types of trusts, for example, that are allowed in California. This is an example of one, we call it an intentionally defective grantor trust. Intentionally defective grantor trust. This type of trust actually is not counted by Medi-Cal as an asset. They've agreed, so long as the language is properly presented there, to not count it as an asset. And the IRS, on the other hand, does count it as your asset. And that's good, because we want any income that's being generated from these assets in this trust to not affect your Medi-Cal eligibility. But we want that income to flow through your tax return, your loved ones, your parents perhaps, or at the point at which you're elderly, right? And your tax return may be quite a bit lower than it is now, or for your parent whose tax bracket is much lower than it is now. We want that taxable income to flow through that tax return and not through a separate trust tax return, which is a much higher tax bracket. And a lot said there. It's kind of difficult to kind of summarize all of that up, I think, but suffice it to say, this special type of irrevocable trust works well with Medicaid in certain states. It also allows you to retain many of your IRS tax advantages with those assets. And it makes it possible to pass on your estate after you've passed away to whomever you designate. It's essentially a will that does all those basic things that a will or a trust does, which such as designating who are your heirs and who's to manage your affairs, but it does so in a way that also allows you to be prepared for certain government benefit programs.
Thank you so much there. And this is just a rest of the planners. You'll be seeing most of them in the coming weeks for the other presentations. And so why don't we go ahead and move on to the questions?
Thank you, Paul. Thank you, John. Great presentation. I think a lot of really good insights. Paul, real quick. So there's a number of questions that all pertain to the same slide. So can you move back, rather than I do the first question in here, to slide 11 really quickly? It was pretty early on with the line charts. And so this one, it gets kind of the question. It shows, how much you should set aside at different ages. But can you kind of talk through real quick, Paul and John, the differences between the yellow and the blue line? And maybe the differences at different ages too, and kind of explain how this slide's working.
So in this example, I circled out of convenience just age 65. So we see those three numbers, right? Under age 65, we see 18,500. Then above that, we see 107,000. Then above that, we see the 131,000. Those numbers represent the present value. You're a 65-year-old person, okay? This represents the present value of all of the streams of cash you would have to pay in the future for your long-term care under these different methods. So in other words, if I decided the method I wanted to do was long-term care insurance, then that's going to have some annual premiums, right? For the next 10 years, it's going to have some annual premiums all the way up until when I turn 75 and I start to need my care. Well, what if I didn't want to bother with writing out the check each year, and I just set aside some money into an account that Paul or Chad set up for me and invested for me, how much money would I have to put in there today and never have to think about it again? And it would basically fund or pay for the premiums of that long-term care insurance for the next 10 years. And the answer is, I would need to set aside $18,500. That's the present value of all those future payments. That's a financial term that's commonly used. That's a present value. Suffice it to say, it's just how much money would I have to put aside and give to Paul today to invest for the future? It'd be $18,500 to pay for those long-term care insurance premiums. Now the $107,000, that's a much bigger number, isn't it? Well, this is a different method. This isn't using long-term care insurance. This is instead the self-insurance way. You know, a lot of people do that. They say, you know what, I don't see a need to pay for long-term care insurance because I've already got a large sizable portfolio. Just tell me how much of that portfolio I need to put as my do not touch money. You know, how much of that would I have to carve out and say, this is money that I cannot spend on anything else. This is just going to be there to pay for my long-term care. How much is it? Now that's the question. How much do I need to set aside? The answer is, if you're 65 years old, it's about $107,000. That's how much you need to set aside. So that number is so much bigger, right, than the long-term care insurance. That's because it's a very different method. You know, just because it's bigger doesn't mean it's a bad way to go. It has some advantages, right? In that if you don't use it, you don't lose it. That's money you've set aside to pay for your long-term care. If you change your mind later on, you really had to dig into that money for something you could. You pass away, that money's going to go to your heir. So that's a big plus to that. So it isn't a given that just because that's a bigger number, that's a lesser attractive option versus the long-term care.
Yeah, I think kind of getting back to it too, if you were to start at age 40, you'd have to put aside about half of that amount, and then it would grow with the stock market to that 107, right? Assuming you have pretty standardized rates of return. So it's all about when you start saving, if you're going to do that self-insurance model as well. So I think
For compounding interest right here.
So I think so with that, and while we're here, I think the first question we actually got today was, with all this in mind, is at what age do you typically see people considering to even start purchasing long-term care insurance or setting aside the assets to self-insure down the road?
Most of the clients that I work with, this conversation doesn't really begin to happen until they start thinking about retirement. And that's typically somewhere between 60 and 65 is when I'm having the conversation with most of these folks. What are you seeing, John? Is that about the same?
Yeah, well, it's funny. We'll get people in their 50s whose parents are needing the care, and then they start to really think about themselves at that point. I think it's an important question that, all advisors should be asking their clients. They should be bringing that up, is that, and not only in the context of what are you going to do about your own care, it's also about, hey, what are you going to do to prepare for your parents' care so that it's not going to eat into your inheritance, or so that it's not going to eat into your personal time. Let's talk about doing some planning for your parents. I've never met them, but frankly, they represent a big potential financial and time burden for you. Let's talk about that.
Good answers. So we talk about self-insurance quite a bit. There's a number of questions in here we'll get through over time, but is using funds from an HSA, for example, would you consider part of self-insurance?
HSA, I think of more in terms of paying for copays on doctors and hospitals. I saw some of the other questions there. Keep in mind that we're not talking about surgeries. We're not talking about doctor visits. Those are covered by your health insurance, and your health insurance may have a copay associated with it. And the HSA account is really a good tool for covering those copays. I don't think it's quite an effective tool really for paying for long-term care, but you could. It's primarily for people that have a high deductible health insurance. What we're talking about is long-term care. Your health insurance doesn't pay for any long-term care. And this is a very distinct, separate set of costs, separate from surgeries and doctor visits and all of that, which is the health insurance matter. This is long-term care.
So I think the next one in here says, there's a question about what about using mutual funds instead of a fixed annuity? And I do think that that is actually on this page, right? I think the darker bluish gray line is the idea of using an annuity, where that bright blue line is really, that's a stock market index that is being used for that example. That could be a mutual fund, it could be an ETF, like any version of a stock market index that you want to use. It could be an active fund, like whatever type of mutual fund or ETF you wanted is, you're being represented with that bright blue line. So the next question we have, and I don't know that we fully addressed it here, but do you guys happen to know any statistics on the average cost of medical care as people age? For example, things like doctor's appointments, possible surgeries, et cetera. And is any of that included in your long-term care?
So the average cost for healthcare, based on the most recent survey I've seen from Fidelity, is around $300,000 over a person's lifetime. So for retired at age 65, expect, going back to that same chart of like life expectancy of 80 to 84, that cost is about 300,000. That is not included in what we're showing here for the long-term care. That is a whole separate expense and a whole separate conversation.
Next question I have for the group is, are long-term care insurance premiums tax deductible?
Yes, they sure are, but it's like I mentioned before, it's just ironic that they are, because most people don't really even benefit from it, because their standard deduction is higher than the premiums they paid each year, the long-term care. So most people don't even really benefit from that, because we have such a generous standard deduction.
Next question we got for the group is, so can existing either term or whole life, especially if there's a difference in the answer, can those be converted to asset-based life insurance? I know there was a point that seemed like you alluded to, yes, they could be converted. So I think we wanted some clarification.
Not term life, because there's really isn't any kind of cash value associated with it. It's more about converting whole life policies. That would be certainly something to consider.
And of course, it has to qualify for the medical underwriting.
That individual, and surprisingly enough, yes, all of that's true. There's medical underwriting, absolutely.
So the next question I have here, well, staying on the asset-based thing, is there any risk of the asset-based life insurance going bankrupt before you actually need your benefit?
There's life insurance companies have state requirements in terms of how much they have to be putting into like a state backup fund. Life insurance companies are rated. There's a variety of different rating agencies, so it's always important to check out what their rating is. Stay away from anything less than an A- rated company. I've never seen a large A-rated company that got into trouble to the point that they disappeared. If they started to have some financial challenges, they usually got purchased or bought out by another larger life insurance company. And as a result, the policyholders were all protected. It's only when you see some of these C-rated or B-rated companies that started to default on their policies. But if you stay with the A-rated, you're going to be fine. They're going to be picked up or by a larger company if something ever happened with them.
Okay, so before I get to the next question, I know there is one in here that says, just in case we had any question for one of the two panelists today. So I just have Paul move to the contact slides. You can see kind of phone numbers, email addresses for either Paul or John, depending on what type of questions you have on today's topic. I know there's a lot going on in this, and I think the hard thing is for most people, it depends on your situation, right? I know everybody hates to hear it depends, but almost every answer, it really does depend on your unique situation. So definitely worth reaching out to touch base. The next question I have in the queue is, we talked a little bit about transferring, spoon feeding, et cetera. How would that be achieved with asset-based life insurance? Is that like somebody comes to your home or you're in a facility?
Some of the asset-based life insurance policies allow you to get your care anywhere you want, whether it's in your home or assisted living. You have to have triggered 2 of those activities of daily living, needing at least help with 2 of them. And then it starts paying out the benefit. They vary in terms of how much per month that they will pay out. In the numbers I put there, I did it based on making sure that we covered at least our bare bones plan. but they cover a variety of different care settings. Each policy has its own nuances to it, but it doesn't take much to trigger them if you need help with at least 2 of the 6 activities of daily living.
So before we move away from the asset-based thing, there's just 2 questions left on it. Is number 1, are you able to define what the asset-based part of that term means? And then the second part of that is, does it require the sale of any home or other property before kicking in? I think this participant says, like a Medicare does, for example.
Well, there's lots to that question there. There's a lot of times people confuse Medicare with Medicaid. Medicare is very reliable. It's going to pay for all your doctor and your hospital. It doesn't require you to have any income tests or asset tests or anything like that. That's health insurance that's just completely independent of any of that. You don't have to sell your house or anything. Medicaid might be what you're referring to. Medicaid does not require you to sell your house. All states are the same about that. There's some states put a limit on the value of your house that you can have. California, there's no limit. Asset-based, what does that mean? I think that was the first part of the question.
Yep.
With the life insurance, I don't know the exact origins of how they began with that. I've always interpreted it to mean that this is an asset. This is more than just this death benefit that happens. This is an asset that can be used as some cash value, or it can be used to trigger an early access to the death benefit to pay for long-term care. That's how I've always interpreted what it meant. That may not be the exact origin of it, but it's certainly the distinguishing feature. Whenever you see the word asset-based life insurance, it's referring to that it has a long-term care feature to it.
So next question is, and we might have already addressed this, but just in case, can an HSA be used for long-term care premiums?
Yes, it can.
I like it, quick and easy. So I know you talked a lot about some of the options for people in California, and we definitely do have a California heavy group, but it is a nationwide audience. Can you talk about any kind of broad things for what options might be available for people outside of California? Especially, I think it's very touching with so many people moving away from California these days to better tax domiciles.
Well, with a touch of humor, I'll say you can always move back. If you started to need the care, you can certainly move right back. There's no residency required. Anyways, that being said, other states, Medicaid is not as flexible as California is. They have what they call a 5-year look back, meaning they want to know about any irrevocable trust that we set up in the last 5 years. So if one was set up 5 years from now, it would be golden. It's fine. It would be beyond the look back window. California has a very short look back window of 30 months, and even that's not really much of a restriction, particularly since the asset limits went away. But for other states, it is, the Medicaid rules are tighter. I think you're going to see a big distinction between how Medicaid works in red and blue states as we go forward. I think is I think there's a whole interesting discussion here about what the heck is it that California is trying to do with this broad expansion of Medicaid. And you want to call and talk about that sometime, I'd be happy to do it. I think it's a fascinating issue.
So the next question is, one of our employers, I think, so you got somebody with a spouse, they pay the benefits for LTD. Would you consider LTD equal to LTC?
No, LTD is long-term disability. That's if you fall and hurt yourself at work and you're missed work for more than 3 or 6 months, that policy will cover your income loss during that time period. Long-term care is you need a certain level of care, not meeting those 2 out of 6 ADLs that we talked about earlier, the daily living activities like transferring, eating, bathing, things like that. And then that's paying for that sort of care.
So the next one, I got 2 on the same thing is number 1. What was the name of that very specific type of trust? You said intentionally defective or something like that?
Intentionally defective grantor, so GRANTOR, grantor trust. It's a funny thing, right? Why would I want to buy in something that's intentionally defective? It's just a legal term that they use that basically the requirement is that the grantor cannot be the trustee, not allowed to be the trustee. And it has death beneficiaries set up in there, but it also has what we call living beneficiaries And that's part of the mechanism that makes it work with some states, is that the grantor is not the trustee. Someone else is managing it for them. That can be a son or a daughter that can do that. But yeah, I mean, that's a whole nother presentation, talk about when to set that up and how does that work. And I just wanted everyone to just be aware that there are tools that are there that can be used.
So I'm gonna keep on the trust questions for a couple of minutes. So when would you say to put in place that type of trust? What age?
I would say that we want to have language in your current power of attorney or your current trust, your current basic living trust, that authorizes someone to establish that for you when the trouble hits. So if you had a stroke and you're cognitively impaired and your son or your daughter has language in that trust that says that they can go out and establish this intentionally defective grantor trust in order to access Medicaid, then that's all we need. We don't need to set it up ahead of time unless you've got lots of medical issues and you've been diagnosed with something that you know over the next few years is going to start to need a lot of care, then that might be a time to get it going too. But really, it's as we get fairly close to the care needs starting.
And then so along the idea of this trust is, so if you have this trust, you said you can collect medical. How does that work?
So if, let's use the example that your mother or your father is going to need you, they've got dementia perhaps, and they're starting to have difficulty walking, and you can see that they're going to need some care real soon, and they're regularly going into the hospital, and you can tell that it's just not going to work out at home anymore. That's when we need to go ahead and set this up. We would move the assets into that trust. There's a methodology that we have to follow in order to fit Medicaid's guidelines. Not hiding anything from Medicaid. We're going to show them the trust. We're going to show them the paper trail of all the funds that are transferred there. There is a methodology at the frequency in which we transfer funds into it. And that's it. And then you may be the one designated as the trustee. Again, this is for your mother or your father. And you're managing those funds that are in that trust. And that opened the door to being able to qualify for Medicaid. And none of the income from those assets are going to affect your mother or your father's eligibility anymore. It won't flow through the income test for Medicaid purposes.
So then before we leave the trust, is the last question I have on the trust thing real quick is, can one of you briefly touch on the difference between a irrevocable trust and a non-irrevocable trust?
So an irrevocable trust is a trust that is set up that can never be changed, hence the name irrevocable. You put the assets in there, and once that trust is set up and the assets are in there, no changes can be made. That's it. Where a normal type of trust, like a revocable trust is your standard normal trust. Those changes can be made throughout a person's lifetime. So a trust that we normally think about is just called a revocable trust. We can update those as we need to. If we want to change beneficiaries, add assets, change the terms of the trust, you can do all that. Irrevocable, once it's done, it's done. Nothing can be done to update or change that trust.
Thanks, Paul. Next question is, what is the current income level that would qualify for Medi-Cal?
Well, it depends on the type, what we're using Medi-Cal for. If we're paying for care in a skilled nursing facility, there really is no income limit. Your income would go towards a monthly share of cost. So no limit, but it's still something we'd want to keep reduced as much as possible, or keep low as much as possible, because it does translate into how much you have to pay the skilled nursing as your share of the cost each month. For outside of skilled nursing facilities, for a single individual, we like to keep their income down below 1,584. And for a couple, it's 2,126. So fairly low. But a lot of retirees, you'd be surprised, do fit within that. And when we do have a little bit of flexibility in how we can lower that.
And so this is the last question I have, unless something else comes in. Paul, can you really quickly go back to slide 11 again? And we did kind of talk about this early on, but can you kind of touch base on why the long-term care insurance goes down later in life. Yes, it actually starts at age 55. You notice it actually starts to go down.
Yeah, can I address that, Paul?
Oh, please.
So it starts going down because the assumptions in this slide are that you're going to start the policy payout, paying for the care at age 75. So there's only so many years, between age 65 and 75 that you're paying the premium. Whereas for someone that's at age 60, there's more years, right? There's a limit in the number of payments you're going to have to make as the age goes up. For someone that's at age 70, there's only going to be 5 years of premiums you're going to have to pay. So the premium amount is much lower for someone at age 70 because the care is going to start at age 75 under our apples to apples comparison.
Awesome. So with that all, Paul, you want to go back to the content information slide real quick? I know one did come in, just asking about licensed advisors. So, Paul is licensed. Every financial planner at BFSG is a licensed advisor as well. And John also has a lot of really good information. So the content information is on the page, financial planning at BFSG, and Paul will get that from this webinar. That being said, that was the last question we had today. I know, Paul, we do need to get to that disclosure at some point. Thank you, everyone, so much for attending today's webinar. Any closing remarks, either Paul or John, as we conclude?
Thank you very much, everyone, for attending. And John, thank you so much for putting on a great presentation today.
Happy to be here and happy to do it. Thank you for having me.
Thanks, everyone. We hope you'll have a great afternoon.